Your name is on a list somewhere. Not a scary movie list, a normal list. Your credit file. And if someone grabs just a few pieces of your info, they can try to take your name for a joyride, new credit cards, a loan, a phone plan, all while you are living your normal life completely unaware. Here is the problem. Identity theft is quiet at the start. You usually find out late when your credit score drops or a debt collector calls. So today we are breaking down how credit monitoring protects you from identity theft in plain English. And stick with me, because there is one alert most people ignore that can save you the most pain. I will show you exactly what it is and what to do the moment you see it. Number 1, the sneaky way identity theft starts. Most people imagine a criminal stealing a wallet. That happens, but a lot of identity theft starts with data you never physically lose. A leaked password, a breached store account, a fake job application you filled out once, a document you emailed years ago. In the USA, identity theft has been one of the most common consumer complaints in recent years, with millions of reports over time. That tells you something important. It is not rare. It is normal enough that you need a simple plan. Example, let us say your email and password get leaked from an old shopping site. A thief tries that same password on your email. If they get in, they reset passwords on your bank or credit card accounts. Then they apply for new credit using your name. The scary part is the timing. The first move happens today. The damage shows up weeks later. Credit monitoring helps you shrink that time gap. Number 2, what credit monitoring actually watches. Credit monitoring is not a security guard that blocks every thief at the door. Think of it like a smoke alarm for your credit file. It listens for changes. Most services watch for things like new accounts opened in your name, hard inquiries from lenders,
address changes on your credit report, new negative items like collections, big score changes. Example, you apply for a car loan. The lender runs your credit. That is a hard inquiry. A monitoring service may send an alert that says something like, a new inquiry was added. That is normal if you did it. But if you did not apply for anything, that same alert becomes an early warning. It can be the first signal that someone is testing your identity. Credit monitoring is powerful for one reason. It helps you catch the attempt early, before it turns into months of cleanup. Number 3, why your credit report is the battlefield. Your credit report is a record of your credit life. It is where lenders look to decide if you are trustworthy. That is why identity thieves target it. A thief does not need your bank account to cause trouble. They can open new credit in your name and leave you stuck, proving it was not you. Example, someone opens a store card. They buy a big TV. They do not pay. That account turns into a late payment and then collections. Your score drops. You try to rent an apartment and get denied. Credit monitoring watches the exact place that thief wants to mess up. And here's a key beginner tip. There are 3 main credit bureaus in the USA. Different lenders report to different bureaus. That means a problem can show up on one report before the others. So monitoring can help you see what you might miss if you only check once in a while. Number 4, the alerts that matter most. Not all alerts are equal. Some are noisy, some are life-saving. Here are the alerts you should treat like flashing red lights. New account opened. Hard inquiry you do not recognize. Address or name change you did not request. A new collection account. A sudden score drop with no clear reason.
Example, you wake up to an alert that says, new address added to your credit file. You did not move. That can be a setup move. Thieves sometimes change your address so bills and cards get mailed to them, not you. This is the alert most people ignore. They think, that is probably a mistake. Do not assume mistake. Treat it like smoke. Find the fire. The goal is not to panic. The goal is to act fast and calm. Number 5, the 5-minute rule when you get an alert. When a real alert hits, your brain wants to do 2 things, freeze or freak out. Instead, follow this simple 5-minute rule, 5 steps in order. Step 1, stop and verify. Ask, did I do this? Think about your recent actions. Did you apply for credit? Did you move? Did you shop for a loan? Step 2. Check which bureau triggered it. If the alert shows the bureau, note it. The account may appear on one report first. Step 3. Contact the company on the alert. If it is a lender inquiry you do not recognize, call the lender using the official number on their website, not a number in a random email. Step 4. Lock things down. If you suspect fraud, freeze your credit with the bureaus. A freeze can block most new accounts from being opened. Step 5. Document everything. Write down dates, names, and what they told you. If you need to dispute, this becomes your paper trail. Example: you get an alert for a new credit card. You did not apply. You call the card issuer, they confirm an application exists. You ask them to close it as fraud. Then you freeze your credit. That one fast sequence can prevent a second and third account from being opened tomorrow. Number 6. Credit freeze, fraud alert, and credit lock. These three sound similar, but they work differently. A credit freeze is the strongest move for most people. It restricts access to your credit report, which makes it much harder for someone to open new credit in your name.
A fraud alert is a flag on your file that tells lenders to take extra steps to verify it is really you. It can help, but it does not block access the way a freeze does. A credit lock is often a feature inside a specific service. It can be convenient, but it depends on the company and the terms. Example: let us say a thief has your social security number. If your credit is frozen, they can still try to apply, but most lenders will not approve because they cannot pull your report. That turns a scary situation into a blocked attempt. Beginner tip: if you plan to apply for credit soon, you can temporarily lift a freeze, then turn it back on. That is control. That is power. Number 7. What credit monitoring does after a data breach. Data breaches are like oil spills. You might not see the damage right away, but it spreads. When a company announces a breach, thieves may not use the data immediately. They sometimes wait because people are extra alert right after the news. Credit monitoring helps during the waiting period. Example: a breach exposes your name, address, and maybe partial account details. For the next few months, a thief might try small moves first: an inquiry, a low-limit card, a phone plan. Monitoring catches those early moves. Also, some services add features like dark web scanning, which looks for your info in places where stolen data gets traded. That does not stop fraud by itself, but it can give you an early heads up that your info is circulating. The big win is speed. If you can spot the first spark, you can stop the fire from spreading. Number 8. The truth nobody tells you about credit monitoring. Here's the honest truth. Credit monitoring cannot prevent identity theft by itself. It's not a force field, it's an alarm. It also doesn't always catch problems that don't touch your credit report. Example: someone files a fake tax return in your name to steal a refund. That may not show up on your credit report.
Another example: someone uses your identity for medical services. That can cause chaos, but it might not trigger a credit alert until a bill goes to collections. So your protection plan needs 2 layers. Layer 1 is credit monitoring for credit-based fraud. Layer 2 is basic identity hygiene for everything else: strong, unique passwords, 2-step verification on email, lock down your phone number with your carrier when possible, be careful with links and attachments, check bank transactions regularly. Credit monitoring is a key tool, just not the only tool. Number 9. Free monitoring versus paid monitoring. A beginner question I hear all the time is, do I need to pay for this? Not always. Some banks and credit cards offer free credit score updates and basic monitoring. Some services give free alerts for one bureau. Paid services may offer broader monitoring, faster alerts, insurance, or help with recovery. Here's how to think about it. Free can be enough if you also freeze your credit and keep good habits. Paid can be worth it if you want monitoring across multiple bureaus, more types of alerts, help restoring your identity if something happens, extra features like scanning and support.
Example: a college student with tight money might use free monitoring plus a credit freeze. That can be a strong setup. A busy parent juggling work and kids might choose paid monitoring because they want quick alerts and guided recovery steps if something goes wrong. The best choice is the one you will actually use consistently. Number 10. Your simple weekly credit safety routine. You do not need to live in fear. You need a routine. Here's a simple routine that takes minutes. Step 1. Turn on alerts. Make sure email and app notifications are on. Step 2. Review alerts once a week. Even if you saw them live, review again. Look for anything odd. Step 3. Check your key accounts: bank, primary credit card, and email login alerts.
Step 4. Keep your credit frozen if you are not applying for new credit. This is one of the strongest protective moves. Step 5. Do a monthly credit report check. Look for new accounts, new addresses, and inquiries. Example: every Sunday evening you glance at your alerts and your main accounts. You spot an inquiry you do not recognize. Because you found it within days, the lender can often stop the process before an account is fully opened. That is the difference between a small annoyance and a life mess. Number 11. Real stories that make this feel real. Let me make this visual with 3 quick stories. Story 1. The first job applicant. A young adult applies for jobs online. One fake listing collects personal data. 2 weeks later, a new phone account appears on the credit report. Monitoring sends an alert for a new account. They freeze credit the same day and stop a second account from being opened. Story 2. The new mover. A person moves apartments. A thief changes the address on the credit file to redirect mail. The person ignores the address alert at first. A month later, a credit card appears. If they had acted on the address alert immediately, they could have blocked that next step. Story 3. The quiet retiree. A retiree does not apply for credit anymore. They keep their credit frozen all year. Monitoring sends an inquiry alert. Because the file is frozen, the inquiry fails or the application gets stuck. They call the lender, confirm fraud, and it ends there. Notice the pattern. The earlier you hacked, the cheaper it is in time, stress, and money. Number 12. If you are already a victim, here is your recovery playbook. If you already see fraudulent accounts, do not spiral. Follow this calm checklist. Step 1. Freeze your credit. This blocks most new credit attempts. Step 2. Dispute fraudulent items with the bureaus. Tell them the account is not yours. Step 3. Contact the company that opened the account. Ask for the fraud department. Request closure and written confirmation. Step 4. Change passwords, starting with email. Email is the master key to resets. Step 5. Keep a folder of everything: screenshots, letters, dates, names. Example: you find a credit card you never opened. You freeze credit first so no new damage happens while you clean up. Then you work the dispute in closure steps. That order matters. This is also where some monitoring services can help with guided recovery. Not magic, just support and structure when you are stressed. Number 13. How thieves use small tests before big damage. A lot of identity theft does not start with a huge loan. It starts with a tiny test to see if you are watching. They might try a low-limit store card, a buy now, pay later account, a phone plan, something that feels small. Example: a thief opens a store card with a $500 limit. They buy a few items and make one payment. That makes the account look real. Then they try a bigger move, like a personal loan, because now your identity looks more believable. Credit monitoring helps because even the small tests usually create an inquiry or a new account entry. That tiny alert can be your early warning before the big damage hits. Number 14. Why inquiry alerts are your early alarm bell. A hard inquiry is often the first footprint of identity theft. It means someone tried to get credit and a lender checked your report. Example:
You are eating lunch and your phone buzzes with an inquiry alert from a bank you never used. That could be a thief testing your social security number and basic info. If you freeze your credit right then, you can block the next application that might happen tonight.
Beginner tip. People sometimes confuse pre-approval offers with hard inquiries. Many marketing checks are soft inquiries. They do not affect your score. The scary ones are hard inquiries tied to real applications. Monitoring can help you spot which is which based on the alert details. Number 15. The address change trick that sets up mail theft. When someone changes the address on your credit file, it can be more than a random error. It can be a setup move. Example, a thief changes your address so the new credit card gets mailed to them, not you. You never see the card, you never see the first bill. Weeks later, you see a missed payment. Now you are playing defense. A credit monitoring alert about an address change gives you a chance to stop that chain reaction before it starts. If you did not request it, treat it as urgent and verify it immediately. Number 16. How monitoring helps with account takeover. Not all identity theft is about new accounts. Sometimes it's about stealing accounts you already have. This is called account takeover. Credit monitoring is not perfect here because not every takeover touches your credit report, but it can still help in a few ways. Example, if a thief takes over an existing credit card, they might request a credit limit increase, or they might add an authorized user, or the account might suddenly report a maxed out balance that drives your score down. Monitoring can catch that score drop or major balance change, depending on the service. Pair monitoring with account alerts from your bank and credit card apps. Monitoring is your credit report alarm. Account alerts are your day-to-day alarm. Number 17. The power of watching all three bureaus. One of the most frustrating parts of credit is that not everything shows up everywhere. Some lenders report to only one bureau, some report to two, some report to all three. Example, a thief opens a card that reports only to one bureau at first. If you only monitor a different bureau, you might not see it right away. By the time it appears elsewhere, the thief has already used it. If your goal is maximum early warning, monitoring that covers multiple bureaus can shrink blind spots. If you are using free tools that only watch one bureau, balance that with freezing all bureaus so new accounts are harder to open in the first place. Number 18. Why a credit freeze beats waiting for alerts. This point is simple but powerful. Monitoring tells you something happened. A credit freeze helps stop it from happening. Example, if your credit is not frozen, a thief can open an account and you will get an alert after the fact. If your credit is frozen, many applications fail at the start because the lender cannot pull your report. Think of a freeze as a locked door. Think of monitoring as a camera that tells you someone tried the door handle. The best setup for most beginners is a locked door plus a camera. Number 19. The credit dispute muscle you should build before you need it. When people panic, they waste time, so it helps to build a simple habit before anything happens. Learn the dispute steps now while you are calm. Example, if you know where to find your credit reports, how to freeze your credit, and how to contact a lender safely, you move faster when an alert hits. That speed can prevent late payments, collections, and score damage. A good rule is this: if you ever see something you do not recognize, do not argue with yourself. Verify, document, act. Number 20. Score drops that should make you look deeper. A credit score can move for normal reasons, but some drops are suspicious. Example, your score drops by 60 points and you did not open new credit, miss payments, or raise balances. That can be a sign that something new hit your report. Maybe a new collection, maybe a new account, maybe a reporting error. Monitoring helps because it can connect the score change to a specific report change. Even if you do not understand credit scoring,
You can follow one simple path. Score drop equals to check the report changes. Number 21. How to protect kids and teens from identity theft. This surprises a lot of people. Children can be targets because their credit history is clean and no one is watching. A thief can use a child's identity for years before anyone notices. Example, a parent applies for an apartment years later and learns a utility account was opened under their child's name long ago. That child becomes an adult with a messy credit file before their first real job. If you are a parent, consider steps like safeguarding documents, limiting where social security numbers are shared, and using freezes for minors when appropriate. Credit monitoring is usually focused on active credit files, so prevention and freezes are often the bigger tools here. Number 22. The two places identity theft hurts most. People think identity theft is only about money, but it often hurts in two deeper places: time and trust. Example, you lose hours on calls, paperwork, and waiting. You might feel embarrassed. You might feel unsafe. Even if you are not financially ruined, you can feel drained. This is why early detection matters so much. Monitoring can reduce the length of the mess by catching it early. Shorter mess equals to less stress. Less stress equals to better decisions. Number 23. The simple personal data rules that reduce risk. Even the best monitoring cannot help if you make it easy for thieves. Here are a few simple rules that lower risk without making life complicated.
Example, do not reuse passwords across important accounts. If one site leaks, thieves try the same password everywhere. Use two-step verification on email because email resets everything. Be careful with public Wi-Fi for sensitive logins, and do not share your social security number unless it is truly required. Monitoring is your alarm. These rules are your fence. Number 24. What to do before you apply for a loan. Beginners worry that freezing credit will ruin their ability to get a mortgage, car loan, or credit card. It will not ruin it. It just adds one extra step. Example, you want a car loan next week. You can temporarily lift the freeze for the time window you need, then freeze again right after the lender checks your credit. That keeps you protected during the months when you are not applying for anything. This is also a great time to watch inquiries closely. When you are shopping for a loan, you expect inquiries. When you are not, inquiries are suspicious. Number 25. The mistake that turns a small problem into a big one. The biggest mistake is waiting. People wait because they do not want to be wrong. They do not want to overreact. Example, you see an inquiry alert and you tell yourself, it is probably nothing. 2 weeks later, you see a new account. 2 weeks after that, you see missed payments. Now, the cleanup is harder. It is better to be slightly early and a little annoyed than late and overwhelmed. Act fast, calmly, every time. Here's the big takeaway. Credit monitoring protects you by catching credit-based identity theft early. It shines a light on changes that usually stay hidden until it's too late. But the real power comes from pairing monitoring with one simple move, keeping your credit frozen when you are not actively applying for new credit. And remember that alert most people ignore, the address change alert. Treat it like smoke. Check it fast. Now, I want to hear from you. What would worry you more if it happened today? A new credit card opened in your name or an address change you did not request? And why?